Hello, everybody. This is Bennett Tchaikovsky, and welcome to Intermediate Accounting. This is Non-Current Liabilities, Part 2 in this series. We're going to be talking about when we have a discount on a bonds payable, and we're going to go ahead and be using that effective interest method. So just a few things here. My disclaimer and copyright notice is that the information and opinions in this presentation are those of myself and not my authors. I'm not my employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2026 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. Throughout the presentation, I will be making reference to publicly available information that is the copyright of other parties, third parties, author. I do not claim any right into those such references. So we're now going to go through over here, and this is kind of a quasi, lower division financial accounting, intermediate accounting with the effective interest method. But let's go ahead and get going on this part here. So, very similar to what we were kind of using before on this example, basically, which is going to be non-current liabilities. We're now going to kind of jump into non-current liabilities, PowerPoint Part 2. Should have set this up beforehand, but I know you guys like seeing the magic behind of what goes behind the scenes. So let's go ahead and go this over here. And we're now going to be doing, it's essentially going to be over here of like what happens if the market rate of interest, we'll call this 11%, and we'll go ahead and do this annually. Okay, so if the market interest rate is at 11%, and we're obviously here at the inverse of this, and I'll get to this in just a moment. Okay, so going back over here to bonds, right? So I issue a $10 million bond that has a 10-year term, interest paid annually at the stated rate of interest is 10%. Interest will be paid on December 31st of each year. The market rate on the date of the bond issuance was 11%. Okay, so if the market interest rate is, so if I can earn 11% on my investments and I'm only offering 10%, what's going to happen is that the bond is going to be discounted to effectively yield that, to yield 11%. So what we know is that my cash proceeds as a result of this, right? So on 1/1/28, right? I'm debiting cash. I'm going to be crediting bonds payable. And whenever I credit bonds payable, it is always going to be at the face amount of the bond, or 10 million, or whatever that face amount is. Okay. Now, at the same time, we know that the amount of cash we receive is going to be less. Why is it going to be less? Because we have to discount it in order to achieve this. So over here, we're going to have a discount on bonds payable. Okay, so this bond is going to give us two different forms of payment, right? We know that at the end of 10 years, right, it's going to be giving us $10 million. But at the same time, because I changed the question, it's going to be giving us, well, every single year, we're going to be earning interest 10%, which is my annual interest rate. And so every single year, it's going to be paying basically $1 million, right? So now let's go through and figure out how we go to the tables to value this bond. So remember, it's really about saying like, well, what amount would I need to invest today to be at 11% to reach $10 million, right? So here, what I'm going to do is for the lump sum is, remember, it's like an interest-only loan. Interest is paid every single year, and then the bond itself is going to be due at the very end of that term. Present value of $1, and then I'm going to need two numbers. How many times am I paying interest? It's a 10-year term bond paying interest annually. So this is going to be 10 periods at the market rate of interest at 11%. So coming over here, present value of $1, 11%, 10 periods. This is going to be 0.35218. So again, when I look at this over here, the present value of this $10 million is going to be $3,521,800. If I invest $3,521,800 at 11%, and I keep on reinvesting that interest every year, by the end of those 10 years, it'll be worth $10 million. Now, for here, because this $1 million is being paid every single year, basically for 10 years, this is what we call an annuity. We can use the table called the present value of an ordinary annuity of $1. And what this is going to be is this is going to be the same factor. 10 periods are the number of times interest is being paid at 11%. So for here, we're going to go to the present value of an ordinary annuity of $1. 10 periods at 11% is 5.88923. So the value of this $1 million being paid out every single year is going to be 5,889,230. Okay, so the way I'm going to check my work is that if a bond is being issued at a discount, when I add up the lump sum and the interest present value, which is here and here, this is going to give me my bond proceeds. This has to be less than the face amount of the bond. So if for some reason, if I get the same number, it means I use 10% as the interest rate, but here I know it has to be less. So coming over here, my discount on bonds payable is basically going to be $588,970. So let's now go over here and kind of do the next things we have to kind of go through and do. Now, on the balance sheet date, as of 1/1/28, we're going to basically have a bond payable. My bond payable is at 10 million less my discount on bond payable. My discount on that bond payable is 588,970. And remember, on our balance sheet, right, this is basically going to be a non-current liability. Why is it a non-current liability? Because, well, one, the interest isn't due for a year, but the interest is a function of time, and that time has not yet passed. But the loan or the bond payable itself is not going to be due and payable until 12/31/37. So my bonds payable net, I'm basically saying net here. Remember, this is not bond payable carrying value. It's bond payable net. And this gets me over here to 9,411,30. Now, as I'm going through and doing this particular question, what we want to kind of say to ourselves as well, when I look at this in terms of T accounts, right, I've got over here, I basically have my bond payable. My bond payable is at 10 million, and then the discount on bonds payable is going to have a debit balance of 588,970. Now, when it comes to this is as of when we get to as of 12/31/37, what I'm going to want this discount to be is I want this to go down to zero, right? Because when I pay off the bond, I want this basically this discount to be at zero. So what I'm going to need to do is when I'm paying interest on this bond, I'm going to amortize, right, the discount on the bond payable. So how do we go through and do this? Well, every 12, or basically, let's go ahead and do 12, 31, 28. So we're going to look at first straight line bond interest or straight line bond discount amortization. So if on 12, 31, 28, I'm basically going to go here and say, well, I'm going to debit interest expense, right? Remember that when we're going through and recording transactions, right, assets equals liabilities plus owner's equity, right? DC, right? Assets have debit balances. They're increased with debits, decrease with credits. Liabilities and equity have credit balancers, increase with credits, decrease with debits. And then I've got expenses and revenues. Okay. So when I record interest expense, this is basically going to be a debit. Now, I'm also paying out cash, right? So every single year, I'm paying out $1 million, right? So that's my interest payment. Now, when it comes to this over here, though, I want my discount on bonds payable to go down to 0. So how am I going to basically go through and get this discount down to 0? Well, I'm going to basically get this to 0. I'm going to have to credit the discount on bonds payable. So I'm going to credit discount on bonds payable. Now, when we do the straight line amortization of the bond discount, right, this is going to be the same entry every single year, because what we're doing is we're taking this discount on bonds payable and we're dividing it by the number of times interest is paid, right? So my interest is being paid out 10 times, right? So right over here, my interest is being paid out 10 times. So basically, right, I'm dividing this by 10. It's going to be 5,897. So my discount on bonds payable is going to be crediting this for 5,897, 58,897, excuse me. So my interest expense is going to be 1,058,897. And this, if I'm using straight line bond amortization, this entry will never change. It's always going to be the same. Now, if I'm doing this using the effective interest method, right, this is going to be a little bit different. And we kind of did this before for the premium on bond payable situation, but it's going to work so slightly differently. So over here on 12/31/28, the format of the journal entry isn't changing. I'm still debiting interest expense. I'm still going to be crediting cash for $1 million, but instead of focusing on this to determine this value here, what I'm now doing is I'm basically saying, oh no, I'm going to determine this, and then this is going to tell me what my discount is going to be. So on the effective interest method, this is what we are focused on. Now to go ahead and do this, right, I'm going to have basically my period, okay, and I'm going to start over here with the carrying value, right? What does that mean? It basically means my bond payable less my discount on bonds payable is going to give me my bond payable net. And so what's going to happen here is I'm going to be debiting, excuse me, I've got carrying value. Then I'm going to take my interest rate. And this is going to be the market interest rate. My market interest rate is at 11%. Okay, so I'm going to take the carrying value. I'm going to multiply it by the market interest rate. And this is going to give me my interest expense. Now, what you notice here is that the interest expense in this case, it's got to be more than the cash, right? Because we know that we're going to have to go through and credit the discount on the bonds payable. So right over here, this is my interest expense. Now, this is interesting. My dad joke for the evening. So the amount, I'm going to compare that to the amount of cash paid for interest. And we'll call this something else. I'll call this maybe called G. My cash paid for interest is going to be $1 million. So my discount amortization is going to be the difference between the interest expense and the cash paid for interest. So right over here, this is going to be 35,213. Remember, we're letting the carrying value drive this over here. Now, got my discount amortization. What do I do now? Well, my ending carrying value is going to basically be my beginning plus the discount amortization, and this is basically going to equal G. So in this case over here, this is now 9,446,243. Let's see why this is correct. So if I kind of move this over here, right, when I amortize this discount on bonds payable, my new ending balance on my discount on bonds payable is going to be right over here at 553,757. This has a debit balance as a liability, right? So it's going to be reducing that amount. So over here, as I'm looking at this down over here, so my ending carrying value, I did a double negative, sorry. 9,446,243, almost screwed that one up. We didn't do it though. It's okay. We can make mistakes. So right over, we want to make mistakes when practicing, not in practice. Okay. So right over here, we got our ending carrying value. So let's go ahead and do this. Now, when we do this for all the periods, right? By the end of period 10, this number here should be really close to 10 million. And let's see if we can get there. Right, so my ending carrying value becomes the beginning for the next period. My market rate of interest is never going to change. My interest expense is now going to be 1,039,087. My cash paid for interest never changes. But then over here, my discount amortization is now going to be slightly higher, and my ending carrying value is going to be going up. So if we take this to year 10, I'm getting pretty close to that $10 million. I'm off slightly. It's okay. Right, I'm off by like 133 bucks. If you're taking my class, I'm absolutely okay with you being off by that amount. So this is how we go through. And again, when we're using the effective interest method, it seems like it's really tough. I usually like when I'm teaching my lower division financial accounting courses, I'll sometimes throw this in as like an extra credit question. But this is kind of how we kind of go through and look at this. But yeah, it's basically you kind of go through and do this, and that's how we go through and use the effective interest method when it basically comes to this part of the question right over here. So I want to thank you for joining me here today. I look forward to seeing you on the next video, and I will see you soon. Have a great day.